every single large corporation, every single large asset manager, every single large bank, every single financial institution of all kinds are really starting to put some form of crypto play into the market. Stablecoins are just going to be a fantastic use case for payment processing, for moving money around the world, and we're going to see the adoption of that come really quickly. And then on top of that, you're seeing that sort of on the back of the adoption and the creation of real world assets on chain. So whether that's private credit bond issuances on chain, or more tokenization of securitized products, or the creation of structured products on chain that look like stablecoins or look like credit funds, I think we're going to see a lot more of that. And so that's going to lead to people wanting to have more sophisticated risk tooling as more serious capital moves into the space.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic from 4RC. Today's show spotlights a new protocol tokenizing the risk of Depeg events for stablecoins and liquid staking or restaking tokens called Cork. In this episode, we sit down with the co-founder of Cork to explore how DeFi investors can hedge, trade, and earn as Cork prices the risk of market-wide depegging events such as the Luna UST crash, or more recently, concerns surrounding major stablecoins such as Tether, USDC, and Ethena USDe. But before we do, just a quick word from our sponsors who make the Edge podcast possible. Hey folks, I wanted to tell you a bit about our sponsor, PYTH Oracles, your go-to source for smarter data to power smarter contracts. PYTH delivers real-time market data for crypto, equities, FX, and commodities to over 80 blockchains. With 120 plus major market participants like Jane Street, Binance, and CBOE, PYTH ensures secure, low-latency feeds trusted by 430 DeFi apps. You can learn more about PYTH by going to pyth.network, and thanks to the PYTH community for supporting us here at the Edge Podcast and Edge newsletter. Overwhelmed trying to manage your crypto and DeFi investments? Meet iYIELD, a free financial planning tool for crypto natives and yield farmers. iYIELD's dashboard compares returns from your DeFi positions side by side, providing clarity to help you make better decisions. iYIELD supports a growing list of over 16,000 tokens and 40 of the top DeFi and staking protocols across 17 blockchains, including Ethereum L2s. The best part is that iYIELD is 100% free, anonymous, and there are no ads. Check out iYIELD.com today to take control of your financial future. Hey folks, I want to tell you a bit about our sponsor, HOURGLASS, the protocol unlocking liquidity for time-bound tokens. With HOURGLASS Boost, you can time boost your assets and earn time-bound tokens that maximize your yield. Alternatively, HOURGLASS also enables leveraged airdrop farming, where you can get over 150x leverage and 10% more points than anywhere else in DeFi. Plus, thanks to their slippage-free market design, you can secure bigger airdrops at better prices. To learn more about HOURGLASS, go to hourglass.com. Launching your blockchain in months? That's so 2020. Launch your network in minutes with TANSSI infrastructure. Restaked security through SYMBIOTIC, plus full customization just a few clicks away. It's 2025. Build smarter, scale faster. Visit tanssi.network to get started. Meet Definitive, the most advanced on-chain trading platform across every chain. Built by Coinbase alumni, Definitive's institutional-grade features lets anyone trade like a pro, featuring advanced order types like limit, TWAP, and stop loss, gasless trading, one-time approvals, and soon cross-chain swaps for multi-chain EVM and Solana. Definitive routes your orders through every liquidity pool to get you the best price on every trade. The alpha is on-chain. Trade it instantly on Definitive. For Edge Podcast listeners, enjoy zero trading fees on your first $50,000 in volume at defidad.definitive.fi.
Bitcoin Layer 2s are everywhere, but Goat Network is different. We're the first to use decentralized sequencers, letting both Bitcoin and Dogecoin secure our network while earning native yield. No nonsense, just your assets working smarter. Our early supporters got it, with over 8 million committed in December alone and already earning returns. Next stop, mainnet launch in Q1 of 2025. Goat Network, where Bitcoin scaling meets real yield. Visit goat.network Get involved and start earning sustainable yield.
All right, let's introduce Phil Fogel, co-founder and CEO at Cork Protocol. Phil, welcome to the Edge podcast. How are you doing?
I'm doing great. Thanks, guys, for so much for having me.
So we're talking to you just a week or so, I think, after the massive Bybit hack. And it's very timely because what you've built is all around tokenizing risk. And so we're going to talk more today about the systemic risk within DeFi. How do we tokenize it? How do we mitigate that risk? But it leads nicely, I think, into what you've been building. And so Cork, we'll talk all about here, but in a nutshell, it's a protocol for tokenizing the risk of Depeg events for stablecoins and liquid restaking tokens. Let's talk first about your very interesting background. You've been working in traditional finance previously, thinking about risk, working with risk products. So maybe you could just kick us off there with a little bit more.
Yeah, for sure. So my very first job was working for an options specialist, trading options on the floor of the American Stock Exchange, which, being that it was on the floor of the exchange, maybe dates me a little bit, unless you know how old I am. But it was a very interesting, eye-opening experience into the world of finance and how derivatives sort of create stability in the markets, but also create opportunity for different investors to express views in the market. After that, I actually started what was supposed to be a fintech company, ended up just being an asset manager. And that during that period of time, I discovered Bitcoin. It was introduced to Bitcoin by a Bitcoin OG, one of Charlie Shrem's original partners in BitInstant, sat me down one day and was like, let me teach you about this thing called Bitcoin. And I was like, wow, this is really cool. I really sort of bought into the monetary thesis of it all. Very quickly tried to start doing arbitrage trading against the different Bitcoin websites that existed at the time where you could buy and sell, but there were no APIs. It was all screen trading, and it was actually pretty scary, given that you had to leave money in Bitcoin on these like unknown websites all over the world. And so didn't do that for very long, but then actually we were mining Litecoin in the office because we thought that was an interesting opportunity. And by 2016, 2017, I had sort of kind of gone all in on crypto, and I started my first crypto company, which was building staking infrastructure. So I was very early into proof of stake. We were early into building MPCs. And at the time, there were all of these masternode and staking coins that were coming out that there was really no infrastructure for, and it was really difficult to actually spin up nodes for these. And so we were trying to build the tool stack to actually make that easier to do. And then in 2020, I ended up going down a carbon credit rabbit hole. And what I very quickly realized is that the blockchain technology was actually this perfect match for the carbon markets, especially the voluntary carbon markets, and that there was a real opportunity to help bring transparency and efficiency to a very fragmented market by building out trading infrastructure. And so the big thesis that I had at Flow Carbon, which was the company that I then founded or co-founded as part of that exploration, was that the actual bringing carbon credits themselves on chain, the bridging of those assets, was going to be very commoditized. It was almost a race to zero if the issuers themselves didn't actually do it, because it was just such a perfect marriage of technology and use case. But the real opportunity that I saw was actually about creating a native financing ecosystem on chain. The thesis was that carbon credits were going to actually provide a real solution to climate change. And thus, we're going to need to create trillions of dollars of carbon credits, and those were going to need to be financed. And if the primitive, the carbon credit itself, was on chain, you could actually create a native securitization and financing ecosystem natively on chain. And that would be one of the first actual markets for large-scale finance in the traditional world to actually exist in an on-chain context. And so I spent a lot of time thinking about different ways to do that, and using existing infrastructure that had already been built on chain, what infrastructure needed to be built. And so went through a couple of different iterations of projects, but unfortunately what ended up happening was the carbon markets didn't really provide the solution that a lot of people had hoped that they would. Web3 carbon markets really didn't take off. And so that idea of there being this like commoditization and native issuance of carbon credits on chain didn't really happen. All the experiments and attempts to do it really started getting smaller and smaller. And so I left Flow Carbon at the beginning of last year to actually start something new. And at the time, one of the things that I had been thinking about and was getting inspired by was credit default swaps, and thinking about how you could build that on chain. And so the origin of Cork is partially coming from the exploration that I did into credit default swaps.
So before we go any further, I think we have to ask you, Phil, about that beautiful jacket you're wearing in the background. So I guess, what can you tell us? Is that like some designer jacket?
Yeah, so it's a full tracksuit that was done as a collaboration between Ferocious and Adidas. And Ferocious is a NFT artist that came out of last cycle that's super, super talented, and have a couple of these different things that they've produced and just really awesome. I'll give a shout out to the art that's in the background. We actually have been borrowing office space from a New York City-based artist by the name of Todd Stone, and he graciously has lent us his office while he's in Florida.
Phil, maybe before we dive a bit further into Cork, I'm just sitting over here super curious and kind of fascinated of what it must have been like to work at Flow Carbon with Adam Newman, the former WeWork founder. He's clearly, a larger than life persona from the little that I've seen, but I'm sure you as his co-founder must just have some interesting stories, or even just like, is he kind of like he's portrayed, I guess, on, in the media?
Yeah. I mean, so Adam was very involved at the origin of Flow Carbon and was very instrumental in getting it up and running. But then really didn't have very much of a role after the company was formed and was actually starting to be operational. But yeah, I would say he is a magical salesman and has the ability to just really, I think, convince anyone of anything. And so the way he's been portrayed, I would say, is actually pretty spot on, of that like charisma and magnetism. It's just, it's a pretty magical thing and to see and also to be aware of.
So Phil, one thing you mentioned is credit default swaps. And I want to tie together how those parallel some of what you've built with Cork, but I'm thinking we need to talk more about the why behind all of this. So maybe this is a great place to start to talk about the light bulb moment for why you start building Cork, or what are the problems that exist in DeFi today that need to be solved by something like Cork?
Yeah. So the light bulb moment for credit default swaps was really just an inspiration, right? What does a credit default swap do in the broader TradFi ecosystem? It allows risk to be moved around and allows people to price risk and to create hedging solutions so that you can have, greater capital efficiency, right? If you think about going back to the origin of the credit default swap, it actually came out of the Exxon Valdez disaster, right? And Exxon had this big credit line with JP Morgan, and JP Morgan at the time was very focused on client relationships. So the idea of selling that debt, selling that credit line to another bank was unheard of. You couldn't do it because it would ruin the relationship with Exxon. And so instead what they did is they came up with this way to move the risk. And at the time, capital requirements were very stringent in that actually, because they were able to remove that risk and sell it to somebody else, sell it to another bank, it actually freed up capital requirements that they were able to then do more things with at the bank. And that was sort of where this came from, right? That's the original origin. Obviously, that then, as you move towards 2008, what credit default swaps get used for is a very different purpose. But if you now go back to DeFi as just, again, that's more inspiration for what we want to build and what we want to create for the market. If you think about the pegged asset space, which is now over $300 billion and growing rapidly, right? Stablecoins are just becoming the most obvious use case and the first real low-hanging fruit use case for crypto that's going to get mainstream adoption. You're going to see that market grow pretty rapidly. There's lots of different types of stablecoins, and there's lots of different types of pegged assets, but all of them are functionally a form of credit, right? Whether it's a centrally issued or decentrally issued asset token, you're functionally getting an IOU from somebody, right? Circle, when you take USDC, is giving you an IOU for $1 that you can use on chain. Lido, when they create staked ETH, they're giving you an IOU for the ETH that they have staked for you inside of their decentralized network. Same thing with MakerDAO or Sky, right? Or any other sort of issuer of these things. It's all an IOU. And what you have internally to that IOU is you have different kinds of risks, right? So sometimes you have traditional credit risk like you would at Circle, which we all saw what happened when Circle depegged because we thought that Silicon Valley Bank was going to, completely go under. And so you have credit risk. You also have infrastructure risk from the smart contracts and the way that these things are constructed, and sometimes layers of infrastructure risk. And then you have leverage risks and liquidity risks on chain that can also lead to depegs. And so right now, the market prior to Cork going live, doesn't have the infrastructure to actually price any of this in and to create ways to create risk mitigation strategies against these different assets so that you can use them for different purposes.
Phil, there's so much in there. But something I've kind of been thinking about, we were talking about this offline a bit, but this idea of Tether kind of being so big now that it kind of poses a potential systemic risk to DeFi. If something, heaven forbid, would ever happen to Tether, what could Cork do to mitigate some of these systemic disasters here?
Yeah, I mean, so Tether is really, in some cases, people think Tether is too big to fail at this point. But in reality, what the issue with Tether is just the market perception of it, right? At the moment, Tether doesn't have any real meaningful audits that have taken place where people can actually understand the exact assets that are backing it up. And if there was a run on the bank, so to speak, of people doing Tether redemptions, how long would it take them to actually clear those redemptions, right? How long would it take them to sell out of the assets? I think they have something about, 15 or 20% of their assets are theoretically in Bitcoin, which if that actually, and it is technically over-collateralized as far as they report, but if let's say there was a huge run on Bitcoin all of a sudden, what would that do to their redeemability of Tether? And then what would that do to the broader ecosystem? We've heard some stories, and I won't name any names in terms of who did this, but there were some trading desks that used to actually sell puts on Tether. So people who wanted to bet against Tether, they were trading desks who basically said, sure, we'll take the other side of that. And their thought process was, well, if it actually turns out that Tether does go to zero, we're all totally screwed anyway. So what's the difference, right? We can just sell as much of this stuff as we want. And so Tether does in some ways propose a real systemic risk because if it were to go down, much of the ecosystem goes down with it, right? Tether is used not just across DeFi in lending pools and as collateral, but it's also used by a lot of AMMs. It's used on exchanges. It's used inside of perps protocols as collateral. And so if that collateral all of a sudden was massively impaired, that would create a pretty big issue. And so in some cases, it's almost like this doomsday scenario of if Tether turns out to not be fully, if Tether goes to zero, it's a doomsday scenario. If Tether turns out to have some asset impairment and it goes to 99 cents or, 98 cents, that's a little different, right? It's not going to cause a total doomsday scenario, but it's still going to be a pretty bad situation across the board. The way Cork is constructed is we enable the markets to be created that sell what we call a Depeg swap. And so what basically happens is every one of these markets is isolated and defined by a specific redemption asset and a specific pegged asset. And so you can basically create any asset pair. So let's imagine, we can talk about the market we have live right now with Tether, which is we have a market where you're taking SUSDE as the redemption asset and USDT as the pegged asset. And so what happens is that there is $1 worth of SUSDE locked up for every $1 worth of Depeg swap on Tether that is able to be created and sold into the market. And so you can come in right now and buy a Depeg swap on Tether, and what that gives you the ability to do is to basically take your Tether and your Depeg swap and send it into the smart contract that will give you back the SUSDE, $1 worth of SUSDE. And so you are backed up against that redemption asset. So in the event that Tether does Depeg and you're holding a Depeg swap, you're covered.
So if you're following along, you might be familiar with how this Cork product then would work. But for folks that are totally new to this, thinking about protecting themselves or being able to profit from a Depeg, let's just talk through some real life examples or more real life examples. So if we go back to the Luna UST Depeg, let's pretend that Cork existed back then. Talk us through, Phil, what folks could have done to use Cork.
Yeah. So first of all, I think it's probably pretty important to start out by saying that Cork would not have prevented that from happening, but it could have been used in a couple different ways, right? So let's assume that there was a market where it was USDC as the redemption asset and UST as the pegged asset. What you could have seen from that market is where the market was pricing the risk. And so you would have had smart actors or people who understood the way that UST was collateralized who were saying, there's actually a ton of risk in this. I'm going to buy Depeg swaps almost on a spec trade, right? And I'm going to buy it. And so push the price of the Depeg swap up. And once you start seeing what that price is, depending on where the market settled out, because in the Cork ecosystem, you can actually buy both sides of the trade. You can buy the cover token, which makes the Depeg swap cheaper, or if you're buying the Depeg swap, it makes the Depeg swap more expensive. And so you could have people on both sides looking to sort of like balance this out the same way you do in lots of markets. But you would have seen that the risk, and I forget exactly what the yield was on UST, but I think it was like 20% or something. Once you start seeing like the risk premium, right, going above 20% on a Depeg swap, you start to really ask yourself, what's going on in this market? And then people might start unwinding those trades a little bit faster as the market got a signal that this was there. If the people who did own the Depeg swap, they actually would be protected. And so if they had the Depeg swap plus UST, they could actually claim it. How the downside is that on the other side of the trade, right, the people who were buying the cover tokens would actually lose at the end of the day because UST did functionally go to zero. And so that swap was taking place and the cover token holder is now basically end up with all UST, which is functionally worthless. And so in the event that you end up with a market where there is a permanent Depeg, that the amount of that permanent Depeg is going to be absorbed by somebody, right? And so it's going to be the people who are on the cover token side of the trade. If the peg goes to zero, you're going to zero. That side of the trade is going to zero. If it's down 10%, they're going to be down 10%. And so that's sort of the trade-off in the market. Where this becomes really, sort of differentiated against other kinds of Depegs is not all Depegs are permanent Depegs. You have a lot of Depegs that are caused by leverage and liquidity risks where the underlying assets and the underlying backing hasn't changed, right? You see that oftentimes, sometimes you'll see small Depegs in stETH, for example, where, either the withdrawal queue for staked ETH has become long and there's a lot of sellouts and there's a lot of liquidations. And so you'll see a light Depeg. You saw during the Bybit hack that there was a little bit of a stETH Depeg because there was some steep stETH selling by the hacker. And so those kinds of Depegs can offer you protection against those, because oftentimes what happens is when those kinds of Depegs, these temporary Depegs that are caused by leverage and liquidity risks in the market, oftentimes that's also the moment that someone who's holding that underlying asset actually wants to sell as well, right? So for example, the price of ETH is plummeting and people are selling out of stETH, and so the price of stETH is actually trading below ETH, and all of a sudden you want to sell out. You don't necessarily want to take that additional haircut at that moment that you want to sell out, right? And so that's one of the use cases where becomes a really valuable product where there aren't necessarily losers on both sides. It's actually beneficial to the entire ecosystem. And so that leads to lots of other use cases that we can see for this, which include ultimately using Depeg swaps as part of the collateral stack in borrowing and lending protocols, right? Like Aave and Morpho. And because this way you have a lot of people who are doing these looping trades. And lately there's been this trend towards using fundamental oracles. And fundamental oracles are great as long as there is no permanent Depeg and the price does stabilize. But when that doesn't happen, that can actually cause some serious bad debt in these ecosystems and inside of these pools. And so, we saw something, kind of like that when USD 0 plus depegged, where there were a bunch of places that were not so many, but there were a couple of places that were using fundamental oracles for the price of USD 0 plus, where it was functionally pegged to $1. And then all of a sudden you had bad debt for something that over a 4-year period of time will be worth $1, right? But may not be worth $1 in a liquid market that you can actually liquidate to today.
This episode is brought to you by MANTLE, the ultimate Ethereum L2 for builders. With over $2.16 billion in TVL, MANTLE powers multi-billion-dollar yield-bearing assets like CMETH and FBTC, driving sustainable growth and capital efficiency. Plus, MANTLE offers a unique reward station for airdropping different tokens to MNT holders, including one ongoing campaign for 4 million Ethena tokens and another for 570,000 eigen. To learn more, go to mantle.xyz, and thanks to Mantle for supporting us at the Edge podcast and Edge newsletter. Phil, I just want to go back to a term that you've used a few times in case folks don't know what it is. Can you try to explain in layman's terms what is risk premium? And when you talk about pricing risk, can you just relate that back to what would a user potentially see on the Cork application?
Yeah. So to explain that, I'm just going to use a very easy example, right? So let's say we had a market that was a year long. And so that the expiration on the market was 1 year from today. And let's just use a stablecoin example. And if the Depeg swap was trading for 1 cent, right? That would functionally be a 1% risk premium, right? You're paying 1 cent to have that coverage, and that's 1% of the overall asset. If you now think about that, if that same market was for, let's say, a 90-day market, and it was also 1 cent, right, you functionally have a 4% risk premium. And so the way to think about the risk premium is, what is it costing you on an annualized basis to have that coverage? And so, and the really useful thing for looking at that is looking at the annualized risk premium versus, especially if you're buying a Depeg swap on a yield-bearing token, what is that yielding? What is that token yielding? And then you basically can say, okay, great, USDE is yielding 11%, and the Depeg swap costs 3%, right? And so my net yield is 8%.
Phil, I want to ask, what type of users are interacting with Cork? I know it's just kind of going live, but what do you perceive as your core users? Because it's definitely more of a newer, sophisticated product for DeFi. So yeah, who do you anticipate kind of being your primary users? And then also I saw that you're kind of launching with Ethena, EtherFi, Lido, Tether. Curious just how they're involved as well.
Yeah, for sure. I think ultimately there's a full spectrum of different kinds of users, right? There's your DeFi native users who are sort of very risk on, who could potentially use this as a way to speculate, or almost like in a prediction market style. Look at the likelihood of depegs and buying depeg swaps for that purpose. There can be people who are, again, DeFi native yield hunters who are looking at ways to earn yield on these markets. And there's some pretty interesting yield opportunities, both by being a liquidity provider as well as buying cover tokens. And so, for example, we can talk through a couple of the markets that are live now and how those opportunities present themselves. But ultimately, I think this becomes a market that's largely used by sophisticated professional traders and institutions, and also can open up the doors to lots of new adoption of these kinds of markets where they currently, aren't being used because of the different risks that the market can't actually find ways to hedge out or manage themselves. So, for example, we can see more, stETH or staking ETH or staked ETH or liquid restaked ETH used inside institutional products that want to get staking yield if they can buy a Depeg swap that guarantees them convertibility to ETH so that they can do daily in and outs, for example, right? So if you have an ETF that's holding staked ETH or staking ETH in any way, and they have a huge amount of redemptions that come through, right? And there's a slippage in the market to sell that liquid stake product, that would cause a loss that they shouldn't necessarily have. Or if they go to the withdrawal queue, they at least have 7 days before they can get out. That becomes really difficult for that product to manage, like an ETF that's supposed to be able to manage very fast arbitrage and in and out redemptions. Whereas if they were able to use a Depeg swap, that's actually now great. I have instant redemption to ETH. ETH is super liquid. I can get in and out very quickly. So we think ultimately there'll be more and more institutional use cases. We think that's going to take time, right? I think if you're thinking about a institutional user who's managing risk, I think it's probably not something that they're going to do with a protocol that launched on Tuesday, right? They're probably going to wait for that protocol to have been around for a while, for it to have some level of Lindy, and then the adoption will really come in. So on the other half of your question was about who we're working with. So we've launched 4 markets initially, and we launched those in partnership with Lido, EtherFi, Ethena, and Sky. And so first of all, those are all fantastic partners who have been super supportive and I think see the benefit of this product in helping to expand their reach in their ecosystem, as well as providing market signals to their user base about the risk in the market. And so not to say that the annualized risk premiums that you would go and look at if you were to go to the site right now are actually like a reflection of like the market wisdom. There aren't enough people using the protocol yet. There aren't enough people who understand that this protocol even exists yet for you to really say that the wisdom of the crowd, the wisdom of the market is here. But that's ultimately the long-term goal, is to let this be someplace where the wisdom of the market can come in and actually look at it. And so just to give you an example of how that works, I'll talk about one of the markets that we launched with EtherFi. And so that market uses stETH as the redemption asset. So natively, that market is earning the staking rate, and then it's a Depeg swap against ETH. And so what that means is that if you were to redeem your ETH with your Depeg swap for the market, you're going to pull out stETH. right? And so right now that market has an annualized risk premium of about 2.15%. And so that means that you can buy, basically you're paying on an annualized basis, you're paying about a little over 2% to cover your ETH position against ETH. On the other side of that market, if you were to buy the cover token, you basically have a fixed return of 2.5% on top of ETH, right? So the ETH rate is right around 3% right now. And so that market is, if you were to buy that cover token with, starting with ETH, you basically are going to be earning a little around 5%, a little over 5%, which is actually a pretty interesting, and nice yield to earn on ETH/ETH. And your risk in that market is the ETH and ETH. Those are sort of your big risk factors in that market. And earning 5% is a pretty decent yield on that. And so people can go in and buy the cover token. And when you go in and buy the cover token to lock in that 5% yield, you're pushing down the price of the Depeg swap. And so that makes the market, that actually will lower the risk on that market. And so that keeps those markets in line. And then if somebody else comes in and says, great, now I want to buy more Depeg swaps because the price has gotten cheaper, right? That will ultimately align the market. And so that's how the wisdom of the market could work on a market like that.
Yeah, it's really interesting. There's so many use cases that I definitely didn't even think of, obviously, until you're just kind of jogging my mind with other potential use cases. The thing you mentioned right off the top too, with institutions, potentially with staking ETFs, I feel like it's just super timely right now. And to your point, maybe it's not today or tomorrow that they use Cork, but eventually, as you grow more lendiness, maybe over time, it's definitely an interesting kind of symbiotic relationship that could happen there. So super fascinating. The other thing I'm kind of curious about is just, do any of these players like Ethena or EtherFi, do you foresee them using this product themselves? There's a clear path to institutional, sophisticated actors using these products, but could Ethena, or is there a reason for Ethena to engage in using your product for their own cover? Does that make sense?
Yeah, so I actually think that one of the most interesting and potentially low-hanging use cases, as we scale the markets, there also obviously has to be some pretty big size and Lindy for this to work. But I actually haven't looked recently, but I looked a couple of weeks ago before the Bybit hack, and Ethena had as collateral, it had a couple $100 million of ETH, but $1.2 billion of ETH. And one of the big reasons why they have $1.2 billion of ETH as collateral instead of that all being ETH is because, as we spoke about earlier, Ethena needs to be able to liquidate those positions really fast if there are redemptions, and to cover those short positions as well, and to close out that sort of carry trade, right? And ETH just isn't liquid enough in order to do that. And so in theory, if there was the ability to buy enough Depeg swaps on the ETH market where they could get out to ETH quickly, they should theoretically be willing to pay almost up to the staking rate on a good portion of that, because it now basically is giving them additional yield that they otherwise wouldn't have. And this follows through for anyone who's sort of in that carry trade and playing that market. And so there's a lot of really interesting use cases that come from other people who are doing similar things in different places where they can get that guaranteed exit at a specific predefined price.
For folks that are watching the podcast, we'll try to weave in some screenshots, but if you're listening, I would recommend you go to app.cork.tech. That's the actual application. Let's pretend you are protecting yourself against Tether. I guess, how do you guys think about creating swaps here that aren't going to be affected from a contagion of something like a Tether Depeg? I think Tether's the elephant in the room. It's the one we're all most worried about. And it's part of the reason Nomadic and I were so into or so excited about what you guys are building.
Yeah. So it's sort of really interesting to think about, because inside of the stablecoin world, there is no native stablecoin that is 1,000% secure, right? In the ETH world, ETH is this native base asset that exists. And so you can create any market against any LRT or LST that goes back to ETH. And sort of you always have that okay, great, I actually have the actual thing, where you can't go back to on the stable coins oh yeah, I've actually got $1 here, right? All you can go back to is another stable coin. So inherently in any stablecoin pair, there is some level of risk that if everything goes to hell, right, like maybe everything goes to hell and there's nothing left, right? And so that's really sort of a challenge that exists. And so the way that we've addressed that is to think about, at least in our initial market creation, is which assets should be uncorrelated, right? And so one of the reasons why we created the SUSDE USDT market was because those should be uncorrelated, right? If tethered depegs, it shouldn't really affect all that much USDE and Ethena, right? And so there shouldn't be that much correlation between those because the way that those assets are created are totally different, right? One is a basis trade that's backed up by a long and short ETH position or a long and short Bitcoin position. The other one is backed by off-chain assets that are held in custody somewhere. So really different structures. So, you can think about ways to construct markets where you have to sort of understand the risk when you're going into this, right? So like knowing you're buying this tethered depeg swap, USDE is the underlying asset that you're going to be able to redeem out. More markets can get created over time where it has the same exact pegged asset, but a different redemption asset. And those might price differently because the pricing, the risk in them is different, right? And so even thinking about like the ETH markets, right? Like you have the two markets that we have now in the ETH space, we have an ETH to STETH market, and then we have a STETH to EETH market, right? And you can daisy chain those so that you can get back to from EETH directly to ETH, but you can also just think about, okay, what is the risk level that I'm taking from going from EETH to STETH? And so it's something that you should be aware of when you're entering into these markets, and especially as we move, down our roadmap towards permissionless market creation and factory contracts where anyone can create markets, really something that people should pay attention to.
Hey folks, I want to tell you about our sponsor, GEARBOX, the protocol that reimagines on-chain lending. With GEARBOX, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about GEARBOX, go to gearbox.fi.
Egg, a quite astonishing commodity, the cause of your desire. Egg, which fills the inner void. Egg.
Eggs are pretty epic, but you know what's more epic? Paying for them with crypto. Borrow, earn, and now pay with MOONWELL.
Say hello to Puffer UNIFI. Puffer Finance is expanding beyond native liquid restaking with new products such as UNIFI-based ROLLUP and UNIFI Pre-Confirmations AVS. UNIFI is not just another L2. UNIFI is a based rollup, one that will solve L2 issues, such as slow withdrawals versus instant withdrawals with Puffer UNIFI. Puffer UNIFI is fast, capable of sub-second transactions. UNIFI also has boosted Puffer points, which means if you bridge assets, you earn boosted Puffer points and rewards from dApps on UNIFI. Puffer's core products mean a bright future for Ethereum. Learn more at puffer.fi.
Phil, I want to go back to the Bybit hack again, just because it's a fresh event that just happened. And you actually brought up a component of Ethena in that hack that I hadn't even thought of, which is just this mechanism to maybe redeem STETH faster using your product. So I hadn't even made that connection. That's super interesting on itself. But where else in that flow of the Bybit hack could Cork have been beneficial? I mean, my mind kind of just immediately went to, USD Depeg scenario. But maybe just kind of highlight again the Bybit hack and how Cork could have been helpful for Ethena.
Yeah, so USDE did lightly depeg during that hack, and I think that was largely based off of speculation and rumors and people not knowing what was going on, and sort of like the headline that was initially that people saw was, oh, Ethena keeps assets at Bybit, specifically ETH and STETH, right? And those have been hacked. In reality, they were the Ethena-owned collateral was not the collateral that was hacked. They're held in copper, and it's a totally different setup. But it did underscore probably what is the biggest risk to the Ethena ecosystem, which is time and time again, I think it's been like 3 or 4 times now where you've had big market drawdowns and the carry trade unwind. Ethena has been able to manage those with no real Depeg and been able to fully honor all redemptions that have come in. And so the mechanism internal to that carry trade seems to have been proven out pretty substantially that works, right? And that is not going to cause a Depeg. In fact, what we've seen a couple of times is actually a profit being generated during those unwinds because of how fast the turnover happens and what happens to the short positions and where the short positions price themselves. But the real risk is that these assets, that the collateral assets are being held somewhere, right? And that could those collateral assets be hacked? And that is, in my mind, the biggest risk that you have with Ethena. And I think, Ethena has done a tremendous amount to actually manage that effectively. And that's sort of what we saw with the way that they have their copper segregated setup actually created, is that it is much more secure than the other setup that Bybit had for that $1.5 billion, right? And that was not hacked. And so I actually think that Ethena is looking pretty good right now in terms of, its stability and its ability to hold a long-term peg, and is proven through now several big, the largest liquidation events in crypto, as well as the largest hack in crypto that theoretically could have affected it, that it's got a pretty secure footing.
Yeah, I totally agree. It's seemingly battle tested now in kind of a short period of time. It's kind of crazy how many, wars are waged on chain and in DeFi and in crypto in a short period of time. So I want to zoom out just a little bit and just talk to you, Phil, about, why do you think DeFi is mature enough now to kind of accept a product like this? What signals are you seeing as a builder that's yes, now is the time. We're mature enough. I almost laugh saying that we're mature, because if you're in the space and you are aware of some of the events that go on, we are not mature, but
we're getting there, right? We're getting to that level of maturity where risk tooling is becoming essential. You have more and more institutional players coming into the space. I mean, I've, for the last, 7 years or so, have been talking about institutional adoption of crypto, and have spent the vast part of my career actually in those years trying to talk to institutions and get them to adopt crypto. And I felt like last cycle we were really, really close, just before the FTX hack. And then that sort of just ended those conversations pretty abruptly. But I now think that there's real momentum, and every single large corporation, every single large asset manager, every single large bank, every single financial institution of all kinds are really starting to put some form of crypto play into the market, right? Whether it's Bank of America the other day announcing that they're going to launch a stablecoin, or Bank of New York Mellon's coming out with custody solutions. These are all things that are moving towards more and more institutional adoption, and I think stablecoins are going to lead the way. Stablecoins are just going to be a fantastic use case for payment processing, for moving money around the world, and we're going to see the adoption of that come really quickly. And then on top of that, you're seeing that sort of on the back of the adoption and the creation of real world assets on chain. So whether that's private credit bond issuances on chain, or more tokenization of securitized products, or the creation of structured products on chain that look like stablecoins or look like credit funds, I think we're going to see a lot more of that. And so that's going to lead to people wanting to have more sophisticated risk tooling as more serious capital moves into the space.
Phil, something that I was just thinking about as you're answering that last question was just how does a protocol like Cork make money? Where are the points of profit taking for this to be, a sound revenue generating business for hopefully many years to come?
Yeah. So we talked initially about the core mechanic inside the protocol that actually allows for the redemptions of assets and the swaps to take place. There's a second piece of this, which is that we spin up for each market a liquidity vault. And the liquidity vault, you basically send the redemption asset into the liquidity vault. It takes care of the splitting of covered tokens and Depeg swaps. And then it also runs an AMM, which we've built using UNIFI for hooks. And so that liquidity vault also collects protocol fees. And so we have a couple of fees where along the way, where if you actually do a redemption, there's a fee. You can also, there's the ability to do a repurchase out of it. So if someone has sent their Depeg swap and their pegged asset in to pull out the redemption asset, there's actually a function where you can buy that back, those two tokens back out for a redemption asset. So if you had a Depeg and then that pegged asset went back to its peg, you can now profitably buy those two things back out. And so there's a fee on that as well. And we route those fees through the liquidity vault, and then we have a fee switch on top of those fees. And so the fees basically coming from the AMM trading fees and those protocol fees can be routed back to the protocol into a potential future token of the protocol.
Phil, what else do you have planned in the roadmap for Cork? And would love to also talk about like how you see DeFi maturing over the coming years and how that all sort of fits into this roadmap.
Yeah, so there's a lot on the roadmap. So, one of the first things that we're going to push out next is what we call a perpetually protected unit. And what that is, it's a wrapper contract. And that wrapper contract will take in whatever the pegged asset is, plus the Depeg swap for that pegged asset, and wrap it into a single token that can be used throughout DeFi. And the nice thing about that and what makes it perpetual is that it actually rolls the Depeg swap over at each maturity for you. So what you can think about that is if your pegged asset is yield bearing, it's going to just take basically a portion of that yield to keep buying Depeg swaps for you. And so that you have a set it and forget it token that is perpetually hedged. And that can then be used as collateral on a lending pool. It can be used inside of an AMM to create impermanent loss protection. A lot of different use cases for where that can be ultimately used. I mentioned briefly that we built our AMM on top of UniV4. One of the really interesting things about UniV4 is that you actually can create concentrated liquidity positions. And so ultimately, we think that there's a really big opportunity to have these markets have theoretically things that look like limit orders on top of them, as well as being able to provide concentrated liquidity from either managed vaults or automatically managed vaults. So if you think about the ETH market, right? If we wanted to go and sell Ethena $1 billion of coverage, right? First of all, you need a lot of liquidity to do that, but you'd also need the price to not move so much if you did that. And so one of the things that you can do with a concentrated liquidity setup is to look at in a market like the ETH market and say, okay, great, we're going to actually have very concentrated liquidity as long as ETH is on its peg. And if it moves off its peg, we can actually remove the concentration of liquidity and have it go to a much wider band of liquidity. And this allows for larger orders to come in without moving the price as much. And that's things that we can do, bringing your risk curators into the process to actually help manage those vaults, help to create meta products on top of some of these products. So for example, if you have 5 different markets for LRTs that are built on Babylon or Ethena or EigenLayer, you can actually then tease out the risk of what's the market pricing the risk of EigenLayer or Babylon at, as opposed to the individual risk from the LRTs, where their risk could be coming from the fact that they have very low liquidity or very high leverage or some other risk factors that are specific to the LRT, and you could actually tease that out. And then ultimately, we think about as the product gets more mature and has potentially we want it to have additional use cases. And so we want it to actually have more flexibility than the V1 of the product has. And so we're already starting to think about where a V2 goes, where you can build in different kinds of conditionality and different ways to improve capital efficiency in the market to create different kinds of swaps that the market can use to create more and more risk management tools.
Very cool. That rep token you mentioned right off the top is super interesting. That almost strikes me as becoming maybe like the default front end user access point for the product in some way. When you basically take away the friction of having to go to the app and do it yourself, essentially, you can just buy this already wrapped covered token and it perpetually rolls over and covers you, I guess, if I'm understanding that correctly. That's pretty cool.
Yeah. I mean, that can be distributed in a lot of different places. And so it ultimately can remove people from having to come to our front end to create a product like that and move it out into, front ends on wallets where there's, someone who wants to do a safer product. And they're basically able to say, here is the yield that you're paying on your saver product that is functionally as safe as whatever the redemption asset is, but is actually getting its yield from Ethena, right? Or getting its yield from Sky, or getting its yield from whatever other products the market sort of has that are high yielding in the moment. And so you can create that and it becomes really easy. Creating those where they're actually purchasable at any front end, and so that you're just, able to do that and make that really simple is, we think, ultimately a really strong indication of how the market's going to move in terms of understanding and managing risk, where for lots of new users who are coming in who don't necessarily fully understand the all the nuances of new protocols, they can actually just buy a perpetually hedged version of that product.
Phil, I think this is a great place for us to start to wrap up. So I want to remind our listeners they should learn more about Cork by going to cork.tech. They should follow Cork Protocol on X. Follow Phil Fogg, that's Phil F-O-G on X. We'll put that all into our show notes so you can easily find those references. And then, Phil, thank you so much for coming on. I'm really excited personally for what you guys are building. I think it's a sign of DeFi maturing. I think it's a sign of like how much we've grown up as an industry. And I mean, as of this recording, I think you guys have maybe a little over 12 million in deposits. I'm sure, someday, hopefully we can look back and say, hey, we had them on before they hit $1 billion, because the product you've built, it seems like it is going to not only help DeFi scale, but as DeFi scales, like they're going to have to tap you guys for this kind of like protection or hedging, or even if you want to speculate here, there's also a great yield opportunity too, like for folks that were listening to like how this works on the other side of buying the Depeg swap. Just a reminder, there's a fixed yield there to potentially earn. And that definitely perked up my ears. Reminds me a lot of why, of course, I love something like Pendle. But Phil, anything else you'd like to share before we go? Or maybe just what's a call to action for folks that want to get involved with Cork?
Yeah, I mean, for traders, whether, retail or professional, come check out the product. We're in beta, which means we're looking for feedback. We're always looking to make the product better, making the user experience better. So please, we would love anyone to just come take a look at it. Even if you're not going to use it, take a look at it. Tell us how we can do better, how we can make it simpler and easier to understand. If you are someone who's a pegged asset issuer, we'd love to talk to you about creating markets. And if you're an institution that is thinking about risk management for your portfolio or in the crypto assets that you are involved in, we'd love to talk to you as well to think about how we can help serve you better in the future.
Thanks everyone for tuning in. If you're a talented founder or developer, please consider reaching out to our team at fourthrevolution.capital. And to stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.